Oh, I wasn't live, was I? Well, I'm gonna restart. Hopefully, I actually hopefully this does actually work now, or hopefully sorry about that. Been a bit rusty when I don't get to do this too often. Let me go back from the beginning, and if this all captured it, oh yeah, now it's live. Sorry for anybody who's watching this after the fact. If I maybe repeat myself for 5 or 6 minutes, I apologize about that. So, anyways, next decade. I'm here to talk about next decade's Train 4 FID. Sorry, I just talked for 5 minutes myself apparently before I hit the go live button. Hi, Transient Stacker. Thanks for hopping on the stream. So today I'm going to be talking about next decade and their Train 4 FID that they just achieved. I'm going to talk a little bit about my views on the valuation and why the stock has been dropping. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in next decade, so this video should be for entertainment purposes only, because I could be wrong about everything that I say in this video, and you need to do your own research before making any investment decisions. All right, so next decade did achieve their positive final investment decision on Train 4 at the Rio Grande LNG facility, and they actually did this in a bit of a different way than what I was expecting. They did have one person, the LNG investor on X, who said, hey, I think they're going to finance it this way. And that is, they did not actually issue any new shares. They didn't do any dilution. They issued debt. And that was interesting to me, right? Because now they are not, they didn't dilute with this as I expected them to. And so I'm going to talk about that in a minute and what the kind of implications are for that. But that was a bit of a surprise to me, and that was interesting. And again, props to the LNG investor on X. He kind of called that out, I don't know, a month or two ago. I can't remember. It's been a while, where he said, hey, I think you have this modeled wrong, that they're going to be doing this equity dilution. But anyways, so they achieved their positive FID, and that sounds like a good thing. And then they've recently got some more. They've signed some LNG sales and purchase agreements on Train 5, and so Train 5 is looking very, very likely for them to be able to get a similar FID in just a couple of months, where they can get all the finance together and get everything in place. Now, again, that sounds like all positive stuff. So why is the stock dropping? Right, that was their FID date right there. I think September 9th. And then it's just been dropping since then, and I believe made roughly a new low, at least in recent times, today. And why is that? And to really answer this, you have to look back and see what happened, what was their prior guidance, and what is their current guidance post, as of their most recent investor presentation. And this was their prior guidance. This was their investor presentation from, I think, May of this year, and you can see their guidance for all 5 trains combined, once they're up and running, was somewhere in the vicinity of $900 million per year to $1.3 billion per year, and that's their 20-year average. Now, if you look at their most recent investor presentation, this has the guidance of $500 million per year pre-flip, and I'll talk about that in just a moment if you're unaware, to $800 million per year post-flip, right? And so real quick, what this flip that they're talking about is initially NextDecade owns, hopefully I get the numbers right, 40% of Train 4, and they intend to own 50% of Train 5. And that is based on the money they put in terms of, the equity funding for those portions of the overall facility. Once, quote unquote, certain investors achieve, some necessary returns, NextDecade will actually then flip and gain an additional 20% equity in each of those, meaning their equity interest in Train 4 will increase from 40% to 60%. And then for Train 5, it will increase from 50% to 70%. That is at least, the current plan. They haven't yet FID'd Train 5, but those are the current guidance from the company. And given that, their cash flows are going to be lower up until the point that sort of flip happens and they gain that incremental 20% equity in Train 4 and Train 5. And so that's what they mean by pre-flip and post-flip. But if you look at these numbers, you can see even post-flip, that's $800 million per year in distributable cash flow, whereas their prior guidance was, at the low end of the range, $900 million up to $1.3 billion per year, right? So the cash flows went down. I also think it factors in, and maybe this is just me being, sort of a dumb retail investor, but I also think they were a little bit ambiguous in terms of what does it mean for another company, for these other investors to sort of get their returns first. It wasn't always clear to me, at least, that NextDecade is going to have lower cash flows for multiple years before they finally get this incremental equity. And again, maybe that's just me kind of misunderstanding, but that is certainly something that I think maybe the market doesn't want to wait as long as they think it's going to take, now that they got sort of more details on what is it going to take, right? Because the assumption here is that they're going to get a $5 margin on all their uncontracted cargoes if they just sell them at spot or on, very short-term contracts. But, if you even assume that, they say the flip won't occur until the mid-2030s. Maybe the market had been assuming that was going to happen earlier, but because, again, mid-2030s is also a very uncertain term. That could be anywhere from, I could see them stretching this from like 2032 all the way up until like 2037 or 2038 even, to say what is the definition of the mid-2030s. And so given the lack of clarity here, I think, it's fair for the market maybe to be conservative or pessimistic and say maybe the company's talking 2038, 2037, somewhere that's pretty far out into the future before they finally get to this $800 million per year of distributable cash flow. And so the market, kind of, I think part of the reaction here is a combination of not wanting to be patient and just seeing the lower projected cash flows for the company. Now, the one thing that I will call out, and I think I alluded to this before, where I expected the company to dilute in order to actually fund Train 4 and again also for Train 5. And they didn't, right? And so I think that makes a material difference here, where maybe the company could have still achieved these cash flows had they just diluted shareholders now in order to get the money to fund their portion of the equity for Train 4 and Train 5, right? Because they would have had more cash flows coming into NextDecade, right? Distributable cash flows, but it would have been spread across more shares. Whereas what they actually did was they have issued debt, and so their distributable cash flow is going to be lower because they have to actually pay the interest on that debt. But at the same time, there are less, there's less equity, there's less shares outstanding that they have to actually split that distributable cash flow across. So, given the fact that this prior guidance did not actually specify like a target share count to go with this distributable cash flow or any sort of a cash flow per share metric, you're kind of talking apples, or it's very ambiguous what they really meant by this and what their assumptions were that were baked into it. Because I believe I've read these footnotes in the past, and I don't think they really specified how they intended to fund their equity. And it was always a question mark for me. And again, I always assumed they were just going to issue common stock and dilute in order to get that money, but they did not. So I think that is, at least that's, maybe I'm totally wrong, but that to me does explain why there's that discrepancy. All right, so all that being said, the big question is, okay, well, the stock has dropped, but really what is the intrinsic value of this? And so I put together a very, very simple sheet. And the reason why it's a very, very simple sheet, if you've seen some of my prior models, they go into a lot of detail and in the actual cash flows, the operational costs and such. But I don't feel that actually adds any value now that the company is giving you much more sort of more fine-grained information or more fine-grained projections that actually do include their interest expense and their G&A expense. So we have an actual projection from the company of this is our distributable cash flow that you can use and model against an actual share count, right? And so I think right now there's somewhere around the order, there's somewhere about 265 million shares outstanding. I even did this. Let's say they have some pretty significant stock-based compensation. Let's say they have to issue a little bit of equity to fund the company. And I just put in a number of, let's say there are 300 million shares outstanding. And again, I know that I'm looking at sort of a current present value, but assuming even more shares are outstanding than now. And that's just because there is going to be some stock-based compensation between now and, let's say 2030, 2031. Because they don't really, they want to reward management, and I wouldn't be surprised if they also dilute a little bit to fund the company a bit, because they're sort of weighing the cost of capital for dilution versus a debt. And the company does not yet have any cash flows coming in to fund themselves, their G&A and their development expenses between now and end of 2027. I think when Train 1 finally comes online, they should have a little bit coming in. So this model assumes kind of no cash flows all the way up until 2031, and this is the company will actually have some cash flows is by I think around let's say the middle of 2027 when they start getting some commissioning cargoes from Rio Grande LNG Train 1. However, this you also, if you read this guidance, they also say you can go in the details here, but basically on one of these slides they say their intent is to use, if I understand correctly, they're going to use this cash flow, all the cash flow they make up until the point of Train 5 finally getting to the point of where it's reached commercial operations, and they're going to use this to actually reduce their leverage, right? They're going to pay down some of this debt. They're not going to be returning this to shareholders. So if I want to do a discounted cash flow valuation and then look at use these projections here where they have their interest expense, assuming that they do use that cash to pay down debt during the commissioning phases and all the way up until the point that Train 5 is actually in full commercial operations, then those cash flows are not coming back to shareholders. They're immediately being used to pay down debt. So from an actual discounted cash flow valuation, as far as shareholders are concerned, there's effectively zero distributable cash flow all the way up until 2031, right? That's the current projection. This is assuming that Bechtel stays on schedule, assuming that NextDecade actually achieves an FID for Train 5 in the fourth quarter, which seems very, very likely at this point, given that they've signed enough sales and purchase agreements, given that they already have the existing agreements with their, the same folks who financed Train 4. We expect them to do the same similar financing for Train 5. Again, that is an assumption and it is a risk, but I think it's fairly, I don't think that's outlandish for me to just assume that. And so if you look at this valuation, you could say, okay, given the company's guidance, finally in 2031, middle of 2031, Train 5 hits, full commercial operations, and now they have cash flows that they could return to shareholders. And for the purposes of this model, I will also call out, I am ignoring Train 6 or anything after that. And so that's a separate discussion for us to have after this point. But if I model it this way and I say, okay, let's say in 2031, maybe I could zoom in, you can see these numbers a little bit better. In 2031, they finally get some cash flows, and let's say that's half a year's worth of operations. And in 2032 onwards, they make $500 million per year in cash flows to the company. And let's forget about the quote unquote flip, right? Let's just look at $500 million per year all the way through for the next 20 years, from 2031 until 2051. And so this is what I thought was basically the most conservative model I could possibly do. So I'm assuming they never actually flip. Let's say they never achieve those additional returns for the other investors. They never get their additional 20% equity, which is unrealistic, right? This is unrealistic on the pessimistic side. But if we even look at that, and then we assume that, hey, they end up doing some stock-based compensation, some additional dilution, and they have 300 million shares outstanding, which is another, I think, 35 million shares more than they have today outstanding. Even if you discount that back today at a 10% rate, that's a net present value per share of $7.45. So that tells you sort of my opinion on the stock and whether it is over or undervalued right now at, $6.45. I think, again, not financial advice, but I think the intrinsic value per share using a bunch of pessimistic assumptions is currently $7.45 per share. Now, if you include the post-flip incremental cash flow, this is when they say in their investor presentation, well, we're going to flip from, once we get that additional 20% equity in Train 4 and Train 5, we're going to flip from $500 million per year in distributable cash flow and go up to $800 million per year, right? So that's an incremental $300 million per year in distributable cash flow to NextDecade. And I modeled that out here. And if I put that in, I was trying to be, again, pessimistic. Let's say their mid-2030s guidance is 2 optimistic. Let's say it happens near the end of 2030s, in 2039. So starting in 2039, they get an incremental $300 million per year, and that continues again through the rest of this 20-year period. So if I add that in, that gets us an incremental value for the company of $500 million in net present value. Add that with the previous net present value of $2.2 billion, gets you to a current valuation for the company of roughly 2.75 billion valuation, market cap for the company. And if you divide that again by 300 million shares outstanding, which is even more than there are at the present moment. I don't know why my camera keeps like freezing. This is weird. Hasn't happened to me before. I might have to get a new one. Sorry about that. So if you do that, then the value per share today, again, this is discounting all those future cash flows from 2039 all the way back to today at a 10% rate. The net present value per share would be $9.15. So, and again, there's, I think, quite a bit of pessimism built into this model. I'm just trying to say, I think the stock is quite undervalued at the current moment. Again, based on this model here, which I think is not only just realistic, but even pessimistic. If I want to be a little bit more optimistic, let's say with their, quote unquote post-flip valuation, let's say you add in, let's say they actually hit this in 2036. When they say mid 2030s, let's say that they have just those couple additional years of $300 million in cash flows. That would get you to an even $10 per share in net present value of intrinsic value, again, based on these future cash flows. So that's just something to consider. And part of the pessimistic assumptions here, and I got over this one, the prior model, with the slide of a different way to value this rather than actually looking at every single year and then, adding those up and discounting them back. If you instead view this as, well, they're going to have this LNG equipment for longer even than, just 20, quote unquote, just 20 years, right? After 20 years, their sales and purchase agreements, the current ones expire, but the equipment isn't going away, right? They can still produce LNG from that, assuming they've been maintaining it over time. Like the lifetime of these facilities is probably more like 40, 50, 60 years, right? These can well outlive the current 20-year sales and purchase agreements. So if instead you say, hey, I'm just going to actually value this as a perpetuity, right? As something that pays me every single year in the future. And that does discount every year, so it gets less and less and less in terms of the net present value. Again, still using a 10% discount rate, that ends up getting you sort of you would value it in 2032 when those cash flows finally start at $500 million per year as, $5 billion of value in 2032. Now you still have to discount that back to today. And if you use that model, that gets you to $8.41 per share if you're just looking at if you forget about the post-flip cash flows. And then if you, again, assuming 300 million shares outstanding, and then if you look at this, again, being sort of pessimistic on the timing, assume they get that incremental 20% equity in 2039, discount that back to today, and that would, give you a current net present value of $10.70 per share. So again, I think these are ways in which you can look at it and say, I think that sort of is maybe a better way to model it than just looking out 20 years, because the lifetime of the facilities probably is much more than 20 years. And so you do add on the incremental value. And I mean, that again is looking at if the stock were trading in the $10, range, $10 and change, I would say it's probably roughly fairly valued given the uncertainty that we have in this stock. When will they actually hit this post-flip incremental cash flows? But again, looking at it right now at $6.45, I think, again, not financial advice, but it certainly seems like even using pessimistic assumptions that, I can justify an intrinsic value for the stock that should be higher than the current share price. On top of that, again, this includes nothing for Train 6, Train 7, or beyond. And, as they've even called it out here, they do have plans. I don't know where it's at in the new investor presentation, but they do have plans to expand beyond just the 5 trains. I'm trying to see where it is real quick. I can't find it here. Site location, no, that's not, yeah. So they're talking about beginning the permitting process for trains 6 to 8, and as I say, they have space for up to 10 trains in total, right? So they could potentially double, and that's a thing where the value of that of those additional trains could be, on a per train basis, could be higher than all the prior each of the prior trains, right? Because they're going to finally have some cash flows themselves coming in, where maybe they could fund 100% of the equity in their future trains. So the upside for train 6, train 7, train 8 and beyond, could more than double the value of the company versus the first 5 trains, right? They have 20.8% equity in trains 1, 2, and 3. So maybe getting train 6, if they had 100% equity, might be worth more than to the next decade, right? Not to Rio Grande, but to NextDecade, might be worth more than trains 1, 2, and 3 combined. And so that's, again, you're going to have to be patient for that if and when they get to that point, because they're starting the permitting process for train 6. An optimistic timeline might be they get that done in, I don't know, a year, I guess. I'm not quite sure. But, under the current administration, maybe they can do that more quickly than it used to be. A year, maybe super optimistic 6 months. Then they have to sign up some customers. They need to get the EPC contracts in place and start that process, and even if you're looking at probably 2 years on an very optimistic time frame for them to get to an FID on train 6, and then an additional, 4 years past that, 3 or 4 years past that to actually get it into full commercial operation. So you would need to be patient to actually realize some of that upside, but it is there. It is possible. So if you have a very long-term outlook on this stock, just valuing it based on trains 1 through 5 is still underappreciating what the potential could be for the company. Again, there is a lot of risk toward that. There's a lot of things that have to go right in order for them to actually expand up to 10 trains, but it's certainly possible for them to do, and yeah, I'll just leave it at that, talking about that portion of the company. But I see it as currently undervalued based off of what, just the valuation for trains 1 through 5 with some fairly pessimistic assumptions. And then we've also seen insiders buying, right? If you haven't noticed this, you had the CEO buy, 280,000 shares at $7, roughly $7 per share a couple of days ago. That was, I guess, last Friday. You also saw another director buy, 500,000 shares, again, above $7, $7.31 roughly. And then this was, I think, just filed today, where you have one of the investment funds that holds a very large stake in NextDecade just bought more, slightly under $7, and 357,000 shares, right? So these folks are putting some money into the company, and putting their own money to buy more of the stock at these current prices. I will say personally, I am buying more of the stock at these prices. I mean, I thought it was, as I said, kind of roughly fairly valued around $10. I was nibbling at $10 per share, and now that it's under $7 per share, I am going to be buying probably with every month as I get money, from my job. I'm probably putting some in here. If it were, and again, this is not me saying that the stock can't go down further, right? I mean, my valuation here is saying, hey, I think even, not, let's say $9, $10 is somewhere in the vicinity of fair value, and the stock has kept going down day after day after day. It was at $8, and now it was down to $7, and now it's in the sixes. Like, it could continue to go down. The market will do what the market's going to do in the short term, and this company doesn't have cash flows, and they're not going to have cash flows for quite a while to really defend their valuation of the equity. So again, I can't call the bottom. If you can, great. But it could continue to go down. But I think long term, if you have a couple a years long time horizon, it's just hard for me to see how, if you hold this until 2030, 2031, that this isn't going to, this isn't going to end up as a quite a nice return for you. Now, I will say there are execution risks, right? It could be that Bechtel does not deliver on time. So there are still some risks there. I don't want to try to say that, hey, these cash flows are zero risk. But I also think Bechtel has a pretty good reputation, pretty good track record. So, hopefully that will not come to fruition. Hopefully they'll be able to deliver on time, and hopefully the company will continue to expand, and history, or the future will show that $6, anything in the $6 range was a very good opportunity. Again, not financial advice. All I can say, is what I'm doing necessarily, and I am buying more of this company as long as it stays under $7 per share. I mean, I will definitely be buying this. Even up into the $8 range, I will probably still be buying. Once it hits up to $9, $10, it's sort of for me personally, it's a question of this versus other companies that are out there and what opportunities there are. But that's, I think that's somewhere closer to fair value. So I think you could still realize a reasonable return even if you were buying this at $9 or $10. Again, you're gonna have to be patient for that, and it's not gonna be crazy. But I would imagine you're still gonna at least get that this incremental year over year 10% gain as the sort of discount rate plays itself out over time. Hopefully that all made sense. I don't see any questions in the chat. There are some folks on here. I don't know if there are any questions. I'm happy to take those if y'all have any. And I'll stick around just for another minute in case there are. Otherwise, I will hop off. Yeah, sorry it took me a while to get around to doing this. And sorry, I have a backlog of other stocks that I do want to talk about. I just, my life is busy. It's hard to find the time to really get on here. Look through my notes to see if there's any other notes I had to mention. I will say that they called out a little bit if you read through the details in their in their 8K, and I guess they had this even in their press release a little bit, where they say there are some management fees that upon FID there was some reimbursement back to NextDecade from Rio Grande LNG Train 4 for development expenses that NextDecade had put into Train 4, and also just some management fees. And I think it was about $100 million right now, and then another $50 million, next a year from now. And presumably, if they have the same thing for Train 5, that would be a total, over the next 2 years, roughly $300 million going back the next decade that will help fund the company right now while you're waiting for cash flows to come in, right? Because there are still expenses, G&A expenses for the company, and whatever the expenses are as they start to develop Train 6 and beyond. All right, so there is a question in here. Chris Redfield asks, why hold this instead of Venture Global? So, I mean, first of all, I'm not trying to give financial advice. I think there's, every company is its own, has its own individual pros and cons. On the flip side, I will say, for me personally, I am buying more NextDecade. I am not buying more Venture Global at the moment. Not that I don't like Venture Global. I just think the way I'm modeling things out, I think the return potential, let me put it this way. I personally think that NextDecade is more undervalued than Venture Global. I do think there is upside in Venture Global. I think both of these companies are good companies. NextDecade, I think at the current moment, just is more undervalued. And again, that might flip if NextDecade goes up by 20-30%, is in the $8 or $9 range. It's closer to fair value. Again, if I recall, I think my prior I did a recent, not so long ago, a video on Venture Global and walk through my current valuation model, and I want to say I could bring it up, but I think where I landed on that was current fair value for Venture Global somewhere maybe in the $17 range. And, so if I think the fair value for NextDecade is about $10, I think the upside to fair value here, let me just do a little bit of quick math. Oh, you can't see my calculator. I guess I could do it on here. 10 divided by 645. So I think there's, again, by my modeling, 55% upside in NextDecade, and what is 17 over? I think the NextDecade or Venture Global is currently valued about 14. Like 21%. Sort of current upside again to fair value for Venture Global. So that's why. And you're asking which one is a bigger position in your portfolio, NextDecade or Venture Global? So that is a good question. I want to say I hold more NextDecade at the moment. I have actually I've increased my position NextDecade by, I want to say 20 or 30% in the past month, somewhere in that vicinity. Oh, I have to switch over to my personal profile. I don't have it on my YouTube profile here to actually look at my stocks. This isn't shown on there, right? No, it's not. Give me one moment and I can tell you the truth, because I don't want to lie to you. But I do believe I hold more NextDecade, and partially that's because Venture Global is only in public for a bit, and the really attractive levels when I really wanted to buy I really wanted to buy Venture Global, it was in April of this year when everything had dropped, and I had to split my money between a number of different stocks at the time. Venture Global was definitely one of them. That's when I got in my initial position. I bought. I don't really disclose how many shares, but I put in a chunk when Venture Global was around $7 or $8, somewhere in that vicinity, and I've added since then. I think I bought all the way up until about $12 per share, more recently. Yeah, so my current dollar, I just give you some context. Sorry, but on the flip side, I've been buying NextDecade stock since 2019, and I will fully admit that was not the best buy. Back then, COVID kind of killed some LNG. It killed a lot of momentum in the LNG exporters. So that, but I mean, I hold it. My style generally is, and this is definitely not everybody's style, but my style generally is I buy and I hold for basically ever until the thesis changes on a company. Are you concerned about a supply glut from all these projects coming online? So I'm not personally concerned about that. I'll give you a nuanced answer. It's going to express itself, right? It's supply and demand. I think there is going to be demand for LNG for a very long time. In the long term, right? In the 20, 30, 40, 50 year time frame, who knows, right? Other energy technology, whether it's solar, whether it's nuclear, whether it's, something else that's not even obvious, right now, there are obviously long-term risks to something like this, because the end product that people want is not directly LNG or even natural gas, it's energy for the most part. There obviously are some uses just for natural gas themselves, but I mean, by and large, the value for this commodity is based on its value to produce energy. So where that is going to come down, I think there is going to be demand for LNG for a very long time, in the same way that there is still demand for coal even today, even though there are many other sources. It's just, what is the price? Now, NextDecade and Venture Global, right, they do have these long-term sales and purchase agreements with as sort of a base for their profits, right, where there can be a supply glut. It doesn't really matter. They still have these 20-year contracts, and so they've got a very, very long runway where you have those predictable cash flows. Now, they do have some uncontracted portions, and so the concern here for these companies is going to be on how much cash flow do they bring in from that uncontracted portion. And if you do go back to their current guidance, that I think is one of the things that the market is a little bit maybe a little bit concerned about, is where they're talking about, well, these are going to be our projections, assuming a $5 margin for all uncontracted cargoes. If there is actually more, a supply glut, as people have mentioned, that's just going to mean the margins of the uncontracted cargoes go down. I think it's hard for me to see how this is actually going to go so low as to be, let's say, unprofitable, right? Just because of the dynamics between drilling for natural gas in the U.S. versus, getting that gas somewhere else. Of course, there is the incremental cost to liquefy it and ship it, but I just don't see how I don't see how there won't still be demand at a lower price. And I think the demand will go up. As the price comes down, the amount of demand will go up, right? And so that's kind of my view on it. Is it's all a spectrum, right? If there is more supply than demand, quote unquote, that just means price has to come down a bit. But I think as price comes down, demand is going to ratchet up in commensurate with that, as people see, hey, prices are down, this is cheaper energy, and we'd love to have it. More energy, more energy, more energy, right? And I think that's kind of the theme that we're going to see for quite a while. That's the theme that we've seen in human history, as far as I know, is basically more energy, more energy, more energy. We always find uses for more energy. I don't see that changing. I think natural gas and liquefied natural gas does serve a role and play a niche in the energy landscape. What about the risk of LNG being a byproduct of oil production if shale drillers start becoming unprofitable and reduce production, then supply for export in the U.S. won't be enough? So I think these companies, and NextDecade has some verbiage. They have some verbiage to this in their actual 10Qs and maybe even just the 10Ks, where they are signing long-term supply contracts with some upstream producer. There is some, you're right, there is some counterparty risk there. And I don't recall, I don't think that they actually disclosed who all their counterparties are. And so it's really hard to say. On the flip side, I think, it is still hard to see that they couldn't get, more natural gas lined up to purchase from someone, right? Because these are all indexed to Henry Hub. It's not like they index to some fixed natural gas price. When I say they, I mean the sales and purchase agreements that NextDecade has with their customers, right? It's LNG is the cost of Henry Hub plus, 15% plus their tolling, quote unquote tolling fee, right? Their liquefaction fee of $2, $2.50 per MMBTU. And the cost of Henry Hub can go really high, right? The LNG producers are going to pass that cost right along to their actual to their consumers. So you're like, I guess if there is, quote unquote, a glut of liquefaction, but a limiting of natural gas, and natural gas prices in the U.S. go really high, and there's, let's say, cheaper natural gas somewhere else, you could have some weird dynamics in the market. And so there are commodity risks. I don't want to pretend like there aren't. There are, and the risks of those uncontracted cargoes for what the impact is on the LNG price, and then also on the flip side, like what you're saying right now, or what you're asking about, is the just not having enough natural gas. I just don't see that they're, given that is price insensitive, I can't see how they wouldn't be able to incentivize some additional company to start drilling and getting more gas out, right? The gas is there. As far as I understand it, there is significant reserves of gas, enough for all this liquefaction, for all the sales and purchase agreements for the next 20 years, right? There should be more than enough natural gas there. Maybe if we're talking over 100 years or 200 years, sure, at some point you literally do run out of the gas. I don't think we're in danger of that over the next 20 years from the numbers that I've seen. And given that the LNG pricing, the sales and purchase agreements, are indexed to Henry Hub can go to $20 per MMBTU, and, NextDecade doesn't care. They're just passing that cost along, right? They're not. It doesn't actually hurt them directly. Now, again, that could negatively impact their uncontracted cargoes, because, if the prices go way up on what they're selling it at, and what their commodity cost is, and actually getting that gas, they may be uneconomical for the folks who are buying it on spot, right? There may be other producers of LNG elsewhere in the world who can produce it much cheaper. So Yeah, and Chris Redfield says, "Thank you for sharing your knowledge. I appreciate it, man. You're welcome." And again, I could be wrong. Please do your own research, but those are just kind of my thoughts on this, given what I know as a non-expert in this field. So, all right. Uh, I don't see any other questions or comments in the chat, so I'm going to hop off now since I've been talking for about 45 minutes at this point. I appreciate everybody who hopped on the stream. Thank you for watching. I hope you all enjoyed it, and have a good one.